Go ahead and get started. Thank you all so much for being here. Today, Professor Crowley from the Goizueta Business School will be speaking to early stage companies and valuation venture capital perspective. And this event is hosted by the Emory Entrepreneur Network, and Aditya is the president, and he will make a further introduction of Professor Crowley. And we're thrilled for you all to be here today.
Thanks, Lindsay. Good afternoon, everyone. Welcome. Feel free to message, just because we've got quite a big group of you signed up. We'd love to see where everyone's joining from, because these virtual sessions, at least, folks from anywhere in the world can pretty much join us. So we'd love to hear where folks are from. So feel free to introduce yourself and give a quick hi from wherever, so we know where folks are joining from. But before that, let's get started. So just a couple of really quick things. For any one of you who have worked on valuations of public or private companies, know how complicated that situation, that process is. It's not an easy thing to do. Now, public valuations, you can at least find comparables. There are financial statements out there, things that you can use as a starting point. But as you start looking at private company or startup valuations, it gets harder and harder. That's kind of the focus of today's Emory Entrepreneur Network virtual learning series sessions. And today we have an expert here who's going to help us with that process. I remember I was just telling Professor Crowley a few years ago, I was in this situation where I was trying to do a startup valuation. I had no idea where to start. And he was nice enough to host a session for alums, and a similar session, and it helped so much. So I'm really excited for this one, because I've kind of not done one in a while now. So hoping to learn more. Now, if for those of you who haven't been lucky enough to take one of Professor Crowley's classes, he's an associate professor in finance at the Goizueta Business School, teaches courses in M&A, investment banking, valuation, private equity, where he places an emphasis on applied finance theory, practical skills, and real-world context. So prior to entering academia, he was an MD at Deutsche Bank, where he closed more than 20 plus M&A transactions, sell side, buy side, joint ventures. He's also worked as a VP at JP Morgan, where he executed a number of M&A transactions related to sell side, buy side, friendly, hostile takeovers, you name it. Over the past 15 years, he's also served as an independent financial consultant and an advisor on select M&A and valuation assignments. Professor Crowley graduated with honors from the Michigan State University and received an MBA with honors from the University of Chicago. So without further ado, Professor Crowley, the stage is yours.
Thank you, Aditya, very much. Thank you, Lindsay, also for the opportunity to be here. I wish we were in the classroom so I could see everybody, but we'll do this. And my objective today is to share with you some ways of thinking about the world of venture capital and how they make investments and how they sort of process information to come up with a valuation. So we'll touch on some general things. We'll do a couple of examples. I'll walk through at the very back end. So nothing too complicated, but maybe just for those of you that have either done some fundraising with venture capital, this is a little bit of a refresher, or if you're contemplating that, then this may be a good first introduction to that. And I'll also say, as a disclaimer, I don't consider myself an expert in the field of venture capital, which, as you probably know, the world of finance has many different specific skills and verticals. My strength was in mergers acquisitions historically, but I have done work since leaving the investment banking industry to help smaller companies, sometimes startups, with issues related to valuation, sometimes in the context of fundraising, and with small M&A transactions that they may be engaging in. So I know that part of it. I know my way around pretty well. But I just want to put that out there. So with all that, let me then jump into the presentation. And again, we'll kind of start with the general stuff, and then toward the back end, we'll see how this sort of plays out in terms of numbers. So let me just say a few things off the beginning. If you think about the world of venture capital is, as it says there, it's pretty much what you would consider a hits business. In other words, if you looked at the distribution of outcomes of venture capital investments, it's not at all a normal distribution. What you tend to find is that a disproportionate amount of the returns comes from a very small set of the overall investment portfolio. And as you may know, venture capital firms who do this for a living, they will make many bets on many different companies, kind of like spreading their chips across a table playing roulette, knowing that only a small percentage of them hopefully will come out right. So they'll make anywhere from 30 to 60 or 70 individual investments. That is different than, say, what a private equity firm would do if they were investing in leveraged buyouts. In that case, they're probably making only 10 investments in their portfolio. So it's a little bit of a different business model. Many of their investments will not be successful. As it says there, the second bullet point, the failure rate is pretty high. And a rule of thumb, and I'd say that this is a very old rule of thumb. I don't think it's as appropriate in recent times, but a rule of thumb would be 1/3 of the investments that a venture capitalist would make would fail. Roughly 1/3 would give them back the money that they invested in without any return. So they put in, they put in 100, they get back 100. So it's sort of flat. And then 1/3 would be spectacular, as it says there, 10x in terms of result. And I'd say that is an old rule of thumb. If you look at the actual outcomes, probably over the last 25 years, it tends to be the case that actually a much smaller percentage of their investments do the 10x time. So probably more like 5% achieve that. And therefore, because the failure rate is so high, as we'll see, the venture capital firms anticipate this, and therefore they expect, or they demand a very high rate of return, sort of a risk-adjusted rate of return. And if things do go well for them, then it could be a great success. A lot of times that will become realized when the company ultimately is either sold, 5 to 10 years down the road, or even better, if they do an IPO, and then they get a very good outcome. This is what I found in kind of recent statistics. And so what it shows you is sort of the breakdown. Again, like I said, it's not a normal distribution. The breakdown in terms of what multiple of return on their money they get. And this is over the period of 2013 through 2022. So a little bit dated, but close to being up to date. And so what you can see is that the gray line is based on the overall dollars invested. The dark blue is based on the financings, the percent of financings. Both of them tell more or less the same story. So if you look at the far right side of that table there, what it shows you is that, let's focus on the gray, say as a percent of dollars. What it shows you is that 1% of their investments deliver a phenomenal return of them getting 20 times their money back. Okay. maybe 2% give them between, maybe a little over 2% of them give them between 10 and 20 times their money back. So effectively, looking at that, this is saying that only in 3% of the cases did the venture capital firms hit the home run of getting 10x times or more. And then in a smaller percentage, they get, say, between 3 to 10. In the biggest outcome, they're close to 1 to 3. And then again, roughly in the gray case of percent of dollars, 37% of the cases, they're getting less than 1 times their money back. And in some cases, that less than 1 time would in fact be 0, meaning they got nothing back. So that's a typical distribution that you would see. And let me advance. And here's some additional information, more or less showing the same thing. What this is showing is, again, if you look at the losers, so the losers in the black here, getting less than 1 times your money. I'm going all the way back to the year 2001 through 2022. You can see that it's a very high percentage, right? In most years, at least 40%, in many cases, 50 plus, in some cases, over 80% are giving them less than 1 times their money back. The extreme winners, on the other hand, the 10x times, you can see very small percentage, right? Anywhere from 1 to 3. It did climb up in recent years, but on average, we're talking about something like 3%. So, and I should point out the numbers in the early 2000s, that 2001, 2002, 2003, 4 period, a lot of that is based on money that was invested during the dot-com bubble. So money went in at what were extraordinary valuations in the late 1990s, and then when they tried to exit, they had very few big successes, and hence you see 80+% of them returned less than 1 times their investment. So that was a phenomenon that was extraordinary in terms of statistics because we were coming through that dot-com bubble. The period subsequent to that, I'd say maybe from like 2006, up through maybe 2018, 2019 is kind of more normal. You can see the numbers bounce around a lot, but they're not as radical in terms of their movement. And then when you get to 2020 or so, we get another shift. And that shift in terms of big rise, in terms of great outcomes, I'll say more about that in a minute, but that was in part due to the COVID experience and what resulted from the injection of capital into the system. When you think about the different stages of when companies access venture capital, this is sort of breaking it up in terms of seed investment versus early stage, and then later stage, ultimately they're an exit. Typically, almost all companies out of the gate, the one line there, that's kind of the curved line, is showing what cash flows, could look like. Almost always in the early years of a company, they're experiencing negative cash flows. It's very hard to launch a business and be profitable year one. So early years, oftentimes for classic venture capital, for at least the first 1, 2, 3 years, cash flows are going to be negative. And then at some point, they may tip a little bit positive. So that's good. And then that is what we would consider then an early stage company. To a certain extent, it's proven itself to some extent, but it's still risky and still has a lot of hurdles to get over. That's when they would raise venture capital. And if aside from the seed, then venture capital will come in different series. Series A and B are the early parts for the development and the professionalization of the company. Series C and beyond normally is about getting greater scale. At that point, the company is much bigger. It's proven itself, and now it needs to expand horizontally in terms of scale. Okay. And then ultimately, if things do go right, then you get an exit, and that could be an IPO or a strategic. Was there a question, Aditya?
Yeah, Professor Crowley, there's a question which, and you may be covering it later on, but and if it is, we can wait. There's a question about AI investments and whether they would have you expect a similar trend to the .com and .com bubble, the burst.
I, it's a good question. Um, I I would not be surprised. So I'd say there's a high chance. And actually, I'll come on to a slide that suggests as much. Um, that was late 1990s was an extraordinary period, but in some ways we're experiencing it again. So I would not, it's a very good question, a very insightful question. I would not be at all surprised if some of the investments that are being made now experience similar outcomes if we could, fast forward 5 to 10 years to see how it all plays out.
Definitely feels like that. Thank you.
Right. Yeah. So that's kind of the life cycle of venture capital. Now, this is just a sort of a representation of how a company may evolve. And so, a couple of points to make. One is that most of the money that is raised from venture capital goes in what they would call that adolescent phase. Um, so the early stage to the medium stage is when capital is most critical. Okay. Um, and a lot of the money that goes into that period recognize that the company is still very much very much at risk, I guess you could say, in terms of proving itself. If you think about, see if I can draw with my pen here a little bit. If you think about the chart here, so the chart on the right, what it's saying is that imagine you have an industry, it could be any industry, and it's progressing, such that, sales are ramping up and it's going to reach a period in time where growth is still positive, but it sort of slows down. And then within that industry, you've got a fight amongst various companies that are being launched. Some of those companies are going to be winners and some are going to be losers. And the categorization of winner or loser is really what happens, at some point in their life. Do they continue to thrive and grow, or do they fall and ultimately, maybe go to zero or barely survive? The key point here is that when you're looking at this part of the life on both of these, they look the same. And so it's really difficult for an investor to tell in that first few years of a company's life which company is going to succeed and be a winner versus those that won't succeed. I mean, in that early stage, they look a lot alike. It's only with the passage of time that we can find out then who ultimately survived and made the right moves versus those that fail. And here's another sort of representation. This is supposed to be based off of actual. Let me go back. That this chart is actual numbers. It's a bit dated, but I don't think it would look very different if we had the data for today. So what this is doing is it's looking at different industries, and you can see the industry classification is there on the left-hand side. So natural resources, construction, manufacturing, transportation, et cetera. It's showing then for companies that launched, pure startups, how long or what percentage of those companies survived beyond year 1, year 2, year 3, and so on. And so what you see is if you had all of the startups classified by these different industry groups, you can see, let's go with, just pick one, say natural resources across the top. You can see after 1 year, 82% have survived. no problem. So you still had a pretty big shakeout, actually. So roughly 18% have died. By the time you get to year two, only 69% have survived. Year three, 59. Year four, now you're less than half, 49.56, et cetera. Such that by the time you get to year seven, of all the companies that launched, only 37%, 36.68% are still operating as a business. So that's a pretty big drop off. And that is true, you can see across the board. It's more extreme in some cases. So, transportation, 31%, information, 24.78%. It has health services here. I think if we broke out health services into biotech, we'd see even more extreme numbers, or medical devices. But the fundamental point is that many companies that launch are going to fall off and not survive. Another way to think about it, go ahead, Aditya.
So
Was there a
there
question?
are a couple of questions from this slide and the previous the two slides that you had. One was around, is a company considered to be surviving if it was bought out? What is
Uh,
the, so I'll
yeah,
let you answer that one and then I'll jump to the next.
yeah. I don't know. I didn't construct the data myself, so I think the answer should be yes. Actually, it should be a success. It shouldn't be considered a failure, but it is true. Sometimes it's hard to keep track. So if they're acquired, in the world of small private equity, small venture capital, sort of tracking data can be a challenge. So it's possible that some of those companies were acquired, but that was not recognized or picked up appropriately in the data. So that would be a
Okay.
case of estimation error, potentially.
Yeah. Thank you. And then there was another question on the previous slide with the curves, and the question was: is this a variation on an S curve philosophy?
To a certain extent, it might be where you see it in private equity a lot of times, even LBOs, right? Where the initial returns are weak and then they turn up, and then the longer that you're in them, they tend to taper off. It's hard to continue to generate the very positive high rates of return the longer you're stuck in an investment. So it is a variation of that, but I think it's more extreme for venture capital.
And I think there's one more question, which was around data on startups versus reboots. So any companies that's around 20 plus years before the reboot. I'm assuming the question is around big corporations, but company that's been around for a while.
Yeah, I don't know. Startups versus I think these are supposed to be pure startups.
Okay, these are all
Yeah,
focused on startups.
yeah,
Okay, thank you.
yeah. Sure. This is a generic representation of how to think about it, is if you think about any company, any industry, sort of what hurdles do they have to get over in order to be successful? In this illustration, it just breaks them down into sort of different you know, key business points that they have to cross. So will the company have sufficient capital? That's a big one. And let's say that the probability of them succeeding is 80%. Then the next one is management capable and focused. In this case, we're just assigning everything at 80%, just for the sake of example. And you can sort of go down the list of key things. Product development goes as planned, competitors behave as expected, customers want the product, pricing is forecast correctly, et cetera. If you cross multiply, let's say that the probability of doing any one of those things correctly is 80%. But then you compound that, you cross multiply that. So, the 80% multiplied times 80% times 80%, et cetera. So 0.8 to the eighth power means that the ultimate probability of success of everything is going to be down there, right? At 17%. And that's the challenge that young companies make. Of course, for your business, you may want to assign different probabilities. You may want to assign different line items there, but that's the risk that the company is facing. So with that as a backdrop, then how do venture capitalists think about how they want to make their investments and what kind of returns that they want on their money? And so what this slide is showing is capturing data from different studies that have been done. And these studies go back, the earliest one here in the column here was done in 1987, and then 89, repeated in 91, 2002, 2018, and then the most recent one I've got here, 2024. What they've done is they've tried to survey the market and get an estimation of what kind of returns the venture capital investor is targeting for the different types of investment. The most risky type of investment would be putting seed money in, okay, a pure startup. Then the second most risky would be what we call first stage or early stage. And then second stage, third stage / expansion, and then ultimately money that's going in at the exit or just prior to the exit, LBO, IPO, et cetera. And so what you see is that the kind of returns that the investors are demanding, it's always the case in every single period that the highest returns demanded are going to be for, this most risky money. In the most recent period, what we see is that, and again, this is based on survey data, but what we see is that venture capital that's putting money into startups is looking for a rate of return per year on their money of 43%. Okay. And that's pretty close to what it would have been here in 2018 from the same source here. Pepperdine University captures private market information. If they're putting money in the first stage / early stage, so this would be a Series A, Series B, then the rate of return that they're targeting is 33. This is off of 2024, 33% per year on average. Okay. Some investments they're going to put more demand on in terms of expected return, some less, sort of depends on the sector and how risky they view it. But those are the types of rates of return that the venture capital world is hoping to generate on their investment. Why so high? Because they know that a good percentage of those investments are going to be wiped out. Another high percentage will give them back their money, but it's basically flat. So it's a very risky proposition. Hence, I'm going to make 50, 60, 70 different small bets on a variety of companies with the hope that one or two turn into that home run. So let me then, with that backdrop, let me get into a little bit on the fundraising side. And I think somebody has a hand raised. I don't know if Aditya, if they can put a question in or.
Yeah, Owen, if you don't mind posting a question in the chat, we'll present that to Professor Crowley. Thank you.
So how then should we think about the fundraising that goes on? Usually, before a firm can raise money, even in the very early stages, Series A, Series B, they have to achieve certain milestones. It can't be just a PowerPoint presentation. You have to have something in place. Hopefully, you've got some revenues. The business it's real, but it's very nascent. It's very early. If venture capital hears the story from the founder, and they buy into it, they accept it, then they're potentially willing to invest. Okay. Now, how much to invest is the question. The company that's raising money, on the one hand, they might say, well, gee, over the next 5 years, in order for everything to work, I'm going to need, $15 million of capital. Okay. It would not be a good idea for the founder to raise all of that money at the outset, because the cost of that money is too high. The rates of return that the VC is going to want, as I just showed a little while ago, is 40+%. So even though we know that they need 15 million, say over the next 5 years, what the venture capital firm is going to do, and it's probably better for the entrepreneur too, they're going to give you some portion of that, which is enough maybe to survive for the next 18 months. Okay. And then in the next 18 months, assuming you hit the milestones that you had targeted for the next 1 to 2 years, or you're on track for that, then you come back and you raise a little bit more money. So they're going to slowly dole out the money based on how the company is progressing. And again, that's probably good for the entrepreneur, and that's the way the venture capital is going to do it. They do not want to overfund. The way that they're going to think about the return that they want and what that means in terms of their investment is, if we're here today, okay, and we know how much money we need to invest, okay, so that money is coming in from the venture capitalist. The venture capitalist then is thinking, okay, I give you whatever, $2 million, $3 million today. That money has to grow over time at, I'm just going to pick a number, say 40% per year. Okay. And so they're thinking about, if I want 40% per year, okay, on this money, then I'm going to figure out, what do I have to get, or what do I hope to get when I get my money back? All right. Whatever that is, whatever that number is, okay, whatever it's going to grow to, I'm going to look at that in relationship to what the overall company is worth at the moment of my exit. And the relationship between what I get back and the overall value of the company, that's how much of your company I want today in terms of equity ownership. So I'll go through that in a couple of different ways. Just terminology real quick. Sometimes you hear the expression pre-money, post-money. So pre-money is the value of your company before you do the fundraise. So in this example, say pre-money, we have something that's worth $5 million. We own 100% of it. If we need to raise $3 million, then the value of our company is going to go up by that amount. So we go from 5 plus 3, we go to 8 million. Okay. Now, if I've given away, or I've sold $3 million worth of my company, and my company is worth 8 million, so then that 3/8 is the ownership stake that the VC is going to want. So they'll say, we'll give you 3 million. We think the overall post-money value is going to be 8. Hence, I want 37.5% of the total outstanding stock, simplistically. Okay. Aditya, back to you. Was there a question or comment?
Yeah, Owen posted his question in the chat, and I think his question was on the table that you showed with the different phases of the life cycle and their percentage returns. So he said, what is indicated by the trend of percentage returns expected? Is because you see it declining? Is it because the risk is declining?
I don't know if that's what the numbers show. You're right. I don't know if, generally speaking, we can say that the risks across the board are declining. I think this is just one of those things in statistics. It's true that if you go back much further in time, you do see higher percentages. So it may be that the environment collectively is changed enough where there's more money available in the venture capital world, a little bit more sophistication, et cetera. But I think if you look at the last 10 years, for example, I don't think I would not go so far as to say that the risks have declined.
All right, thank you.
Yeah. So here is this sort of gets back to the question around, will we experience another sort of post.com kind of washout with a lot of investments. So this is a chart that's showing the valuations of early stage companies. And so this is the pre-money estimated value. So before they put money in, this is the pre-money estimated value of companies going all the way back to 2014. And so what we see is that there has been a very big lift in the overall valuations of companies going back over a 10-year period. Um, a couple of other things to point out. So this like whatever color that is, like a turquoise or light blue dot, that is the top 10%. Okay. That's the value. If I take all the companies that are raising capital and I say which 10% are getting the highest valuation, that's the top 10%. And this one here is the bottom 10%. Okay. So what we see is that the spread between the top 10% and the bottom 10% has gotten wider in recent years. And we also see that the average valuation has gone up quite a bit. But this is a case where I would caution maybe against using the average, depending on what industry you're in. I think the better indicator here is to look at the median. Okay. And so median's gone up too, but not as much as the average. The average has gone up really because of the spectacular values being attributed to companies that are in the AI or the language learning model type business. These spectacular valuations, for the most part, are AI related businesses. Your average other business has not seen anything close to a valuation like that. It's also worth pointing out that the lift in valuation has been substantially due a couple of things. This is a break point right here where I'd say you see a big lift. ZIRP represents zero interest rate policy. So we had a period of really since 2008, 2009, the Federal Reserve maintained interest rates in the United States at close to zero. And that was really the case up until the spring of 2022. So we had very low cost of money. And then in this period here, because of COVID, you had close to $5 trillion injected into the economy in the form of stimulus. Those two things combined, super low interest rates with $5 trillion injected in lifted valuations of everything you can think of, real estate, the overall stock market, right? Venture capital, private equity in general. So that's the outcome that we've seen. Now, valuations have stayed high in part because companies that raised money back here, they raised money at spectacular valuations, and they don't want to re-raise money at what would be considered a down round. So some of these value indications that we're seeing here are high and they're sticky because we've got companies that raised money 24 months ago at spectacular numbers. And even though their valuation in the market today would be lower, they're hesitant to go out and do a fundraise because it's going to be dilutive in a negative way for the owners. But ultimately, they're going to run out of runway and they're going to have to do a fundraise. So I think I would not be surprised if some of these values come down. I also would not be surprised, as somebody said earlier, if in 5 to 10 years we look back and we see a lot of money went in at valuations that resulted in very poor outcomes for the investors. So let me go ahead with back to the fundraising. The idea with the fundraising is that you're trying to raise money, which hopefully is just enough to get you to your next key milestone. We don't want to overraise. If you overraise, you're raising money at a low valuation, and frankly, venture capital is going to be skeptical of your desire to get so much money up front. So typically, when we do a fundraise, we're fundraising such that we have enough money to get us, say, through the next 18 months. Now, if we're progressing and things are going well, you probably want to start fundraising again maybe in 12 months. you don't want to wait until you run out of money, more or less. So if we're raising money that's going to carry us for the next year and a half, probably in 12 months, 14 months at the latest, we need to go out and start having conversations again about the next round of funding. And that's, so we're trying to time it so that we get the money just in time. In part, we're doing that because hopefully, as time progresses, our value of the company is trending up, right? So this is my value and this is time. And so, if I raise money back here, I don't want to raise too much. I want to wait until I need it again, and then I'm going to raise it a higher value. And then again, down the road, I'm going to raise it a higher value. So that's the idea. Continue.
Professor
Back to
Crowley,
you, Aditya. Yeah.
there's a question about multiples. So from Kazi says, from the perspective of the investor, when looking at comps for multiples, how do we factor in the historical high multiples when valuing companies in the current environment, assuming we are valuing a company in the same similar sector with comparable business models?
So I think if you're, I don't know if he's talking about the perspective of the VC firm, but let's say either way, let's say that we were working together and we're trying to figure out what's the right valuation multiple. For the most part, the idea is that the company near term, and really maybe for the next 5 years, is not really generating anything in terms of cash flow that we're going to get back. The value is all going to be on the back end. And this is true for a lot of venture capital type investments, private equity type investments. So we're going to say, what do we think the company is worth in 5 years or 7 years? And we're going to attribute a multiple to that. And a lot of times the multiple for a venture capital is going to be a sales multiple. If it's going to have real EBITDA, we can use an EBITDA multiple, but we're going to take either an EBITDA or more likely a sales multiple. The question is the sales multiple that we're going to attribute to the company's valuation 5 years down the road, is today's multiple a good multiple for that? Or should we look at a longer period of time? And I think the best thing to do would be to look at a longer period of time. Like whatever the industry is, if it's a medical device business, and we know that the multiples today are, 7x sales, 7x revenue, I'd actually want to look at what have they averaged over the last 5 to 10 years. And I think that would be a better way to project what the value is going to be down the road.
So you're looking at a longer period of time and not just if it was crazy valuations the last
Yeah,
3 years. You're not looking at just that.
I agree. That's what of course I agree because I said it, but that's exactly what that's what I'm suggesting. Now,
Okay.
but it is true that when valuations rise and a sector is hot, they're going to get some credit for that, right? Just like we're seeing now with AI. AI, we're seeing spectacular valuations. And in those cases, they're not looking at the average for the most part over the last 5 to 10 years. There's a lot of hot money chasing, this insatiable appetite right now for that kind of technology. So they're getting the benefit of present day high multiples. But I think a good way to think about it is to look over a longer period of time.
Okay, thank you. There's
Yeah.
another question that came in while we were talking right now, and this is from Abram. In the context of VC managers, would you say VC as an asset class is the only one to show return persistence, where managers can consistently return top quartile due to specialized sourcing and relationships?
I would not actually. I mean, I think I don't have any page on the stats for that, but it's it's higher on the spectrum of expected returns or returns realized, but the volatility is very big too. So, the spread in terms of outcomes is wider than you would find for, say, LBOs, for example. Um, and LBOs is wider than you would see for, say, mezzanine financing funds or something like that, right? So Average return is higher, but risk is higher too. Yeah.
Thank you.
Yeah. Okay. So let me get to an example or calculation then, and if we're trying to raise money today. So I'm gonna kind of repeat what I've been trying to say prior to now. If a VC firm is going to give us money and we're fundraising, right? What we care about a lot, of course, is how they value us and how much of our company they're insisting on taking. And in fact, that conversation of you're going to give me capital, the one number that we will be very focused on is how much of my baby, how much of my company do I need to give away to satisfy them? Okay, so that's the example I want to run through. So how does VC think about that? Well, a simple way that we can do the calculation in terms of what we're giving away or what they're demanding to take, it's really just the math of how much money do we need today? Okay. What's the target rate of return that they want? How long do we think it'll take them, or do they think it'll take before the exit? Okay. And then what's the exit value? If we have those numbers, exit value of my company, like we've just been talking about, how long it's going to take to exit, what's the expected rate of return that they want? We looked at a slide a few back on that. And then how much money are we needing? Given all of that, we can calculate how much of our company we need to give away. Okay. So here's an example. Imagine that we have a company and very early stage, okay? And to advance the company, we need to raise 1.5 million, okay? That's all we need right now, 1.5 million. And this entire company, if we estimate what is it going to be worth, let's just say in 5 years, okay? We think in 5 years, the overall company is going to be worth 50 million. How did I get that number? I don't know. It might have been an EBITDA multiple. It might have been a revenue multiple. It's probably one of those two methods. Whoops. Probably one of those two methods. Okay. So 1.5 we need today. 50 million is what we think the overall company is worth 5 years later. Let's just say, to keep the number simple, that the VC investor thinks for this particular business, this particular industry, the return that they want is 50% per year. Okay. So I can get to the estimation of how much of my company I need to give away one of two ways. Okay. The answer is going to be this, 22.78. I can take the 50 million and I can discount it back at 50% per year for 5 years. And if I do that, I'll just double check, but if I take 50% per year for 5 years, the number I get in present value is this, 6.58. So that's 50 million discounted back over 5 years at a 50% rate. 6.58 would be the present value. Thus, if they're giving us 1.5 and the overall value now post money is 6.58, then they would want 1.5 divided by 6.58. They would want 22.78% of our company's equity ownership. Or what we could have done is just take the 1.5, same thing, 1.5, multiply it times 1.50 to the fifth, okay, and get a number. And that number is this, 11.39. Again, 11.39 divided by the overall value of the company at year 5 divided by 50 is the 22.78. So that's the golden number. And that's the negotiation that's going to take place between the founder and the VC firm. How do we give away less of the company? We would need to convince them that it's worth more down the road here, right? I mean, if we can convince them that it's worth not 50, but 80, then yeah, we're going to end up giving away less of the company. But it's going to be hard to change their mind very much about that. And they're going to have a number in mind that they're targeting in terms of their expected return or their desired return. and it's going to be high. Let me do another example. So let's say that we have a company and it wants to, I'll use bigger numbers now. Let's say that it wants to raise $20 million. Okay. So they need $20 million today. Again, we and the VC firm are going to make an estimate of what we think the company is worth at the moment of exit. So in this case, let's say that this is a little bit bigger company. Exit is only 5 years away. We think, sorry, 4 years away. Exit's 4 years away, and we think at the moment of exit, it's going to be worth 350 million. Again, probably an EBITDA revenue multiple. Because the company is a bit more advanced and bigger, it's worthy of a lower discount rate. Okay. So I'd say, let's assume 25% is the discount rate. So the question is, how much of the company do I need to give away based on those numbers? Well, the math is not hard. A lot of finance is just moving numbers through time, right? I can either take the 350 and discount it at 25% per year, over the 4-year period. And let's see, what is that? I think it's 143. 140. I'm not getting it to right there. Sorry, hang on one second. This number here is 143. Okay. So if 143 is what the present value of the company is as of today, then 20 over the 143, that's what I have to give away. 13, call it 14%. 14% of the company is what I would have to give away. 14%. And the other way we could have gotten there, is just to grow the 20%, right? If I take the 20 times 1.25 to the fourth, I think it's 48, 49, something like that. 49. And if I divide that 49 by the overall value of the company, again, same thing, 14%. I just wanted to check my math, but that again would be how much of the company I'd have to give away. So the math is not complicated, right? We're just moving either from a future value to a present value or present value to a future value, very high discount rate. The discussion between the company and the venture capital firm is what's that end point value? Was there a comment or question?
Yeah, Professor Crowley, there's a question from Larry. This is about the endpoint value. So he said, how do they pick evaluating on a sales revenue model versus EBITDA? Is it only when EBITDA doesn't exist yet, it's not making profit, that they go to the sales model? And he gives an specific example. He was part of a software reseller company that was evaluated on EBITDA because the software, the IP wasn't theirs. So they always assume that's why they picked profit EBITDA as the metric. And I think he's trying to figure out, how do they pick between the two models?
Yeah. I think it partly depends on the industry. So some industries fundamentally are going to be based on an EBITDA or an EBITDAR or something close to that. You know, if it's the type of business, if it's a restaurant business, for example, or a clothing retailer or something like that, they tend to be valued on more like or services business of any type. A lot of times, you know, not early days, but once you get out 4, 5, 6, 7 years, they should have EBITDA. Any industrial business EBITDA multiples are appropriate. Um, Other technology businesses like biotech, for example, sometimes medical device, sometimes SaaS businesses, are more along the lines of a sales multiple. So,
Thank you.
sure. And one last slide. We got 5 minutes here, I see. But so I've given this example before, but it just shows sort of re-emphasize the idea of what a hits business can be. So going way back to the days of Google's formation. So Sequoia Capital, one of the most storied venture capital firms to ever exist. They made many great investments, Apple, Oracle, Cisco, et cetera. But they invested $12.5 million into Google for a 10% equity stake, and that was in 1999. Now, this was a dot-com bubble investment that paid off very well. So they put 12.5 million in, and they got 10% of the equity. Roughly 5, 6 years later, the company went public, and they went public initially at 85 per share. Sequoia sold a big chunk of their money. They sold about 2 billion worth of their investment. They didn't sell everything in the IPO, which was good for them because Google's stock price, the IPO price was 85. 6 months later, it was trading at 198. By the end of 2005, it was at 427. So for Sequoia, as the valuation rose, they kept sort of unpeeling their ownership, such that by the time they fully liquidated, they had collected 4 billion in proceeds. So they put in 12.5 and they got out 4 billion for 320 times their initial investment. IRR on that, I don't know, it's like 105% or something like that, for some spectacular number. But this just emphasizes the idea of how venture capital works in terms of you make one of these investments and you can have 50 others that are flat to zero, no big deal. I could stomach all that, and this one spectacular success is going to more make up for it than. And that's the way the movie business is. That's the way the music business is. If I'm Paramount or Sony, I need that one big blockbuster, and that'll pay for all the little ones that didn't do so well. So anyway, that's I've got 2 minutes, so I'll stop there and pass it back and see if there's any other comments or questions.
Yep, that was very insightful, Professor Crowley. Thank you. There is one question that came in a little earlier, and it was in the Q&A section, so I hadn't seen it. This was a question about the slide where you had the pre-money and post-money amounts. So you had the 5 million, the 3 million, the 8 million, and the question was, for a post-money valuation, would it not be higher than the pre-money plus the new money invested, especially if the investment will drive growth, expansion, efficiencies in the company that would not occur without the money? So is there a value to just the fact that you're bringing in the money, and I think the question's around that.
Yeah, not really, because the pre-money value. So let me go back to the slide. Yeah, this 5 million here. So that 5 million in value, that presumes that to basically advance the company, we've got to make some investments, and we need capital to make those investments. So we've got some negative holes there for CapEx or working capital, whatever the case is, to fill. That's essentially what the 3 million is doing. It's filling a hole that we absolutely need for the company to sustain itself. So I would say both of those pictures right there are looking at the same future. The difference is the 3 million says, okay, money's come in. Now we filled the hole we need to cover the CapEx there. And that's why the value pops. But I wouldn't get into that we've introduced more efficiencies. I think that's already captured in the first 5 million view.
Great. Thank you so much. I don't see any more questions. So thank you again for the insightful presentation, the examples, especially if I'm just speaking for myself, seeing the numbers and how they're calculated and play out definitely is very, very eye-opening. So thank you so much for taking the time to do this. Thank you everyone for joining. Hopefully it was as eye-opening to you as it was for me. And Lindsay has posted information about our next session, which is in about a month. So where we'll talk about the benefits of outsourcing for startups. So again, Professor Crowley, thank you so much for doing
Thanks for the
this.
opportunity, and good luck to everybody with your businesses, and have a good rest of the summer.
Thank you so much.